Patrick Moonen. He's senior strategist at ING Investment Management, joins us live now from The Hague. Patrick, it's been a difficult third quarter for global equities, hasn't it? What are your expectations of upcoming earnings?
Well, we do think that third quarter earnings of this year will be higher than in the same quarter of last year. But on the other hand, we also think that, well, earnings may actually disappoint analyst estimates. And we may not forget we are witnessing an economic slowdown. Currencies have been very volatile and sentiment has been weak.
All right, so let's just hone in then on some of the points. I'm thinking mainly about bank stocks and, well, the problems that have been weighing on financial institutions. It's been a very tough few months with a great deal of volatility in the markets. But basically, they're up against two big headwinds, if you like. You've got slowing economic growth and then also the sovereign debt crisis here in Europe. What can we expect from the banks in terms of earnings?
Well, expectations are very low for banks, given the fact that, well, we have a flat yield curve, credit growth is very slow, and we also think that revenues from investment banking will be quite weak. So all in all, we do not think that banks will show us very good earnings.
Okay, so do you see then any reason to be positive on the banks right now? I'm just thinking about valuations, which are certainly lower, but then, of course, to a great many people, this could actually be a great time to buy.
Well, actually, we remain underweight banks, but we have to admit that over the last couple of weeks, we have been reducing that underweight position due to the fact that, well, investor positioning in financials has been very extreme. So, and given the, well, less negative news flow on banks with regards to recapitalization, with regards to policy intervention, well, we think that in the short term, banks could hold up relatively well, but the long-term challenges are and remain very important, and that's why we intend to keep an underweight banks for the time being.
What sort of scenario could potentially alter your position on that? You said that you're reducing your underweight position when it comes to financial institutions. If we were to see some sort of widespread pan-European recapitalization, would that make you, would that shore up your confidence in the banks? Would that make you perhaps invest a little bit more?
Well, I think we need to see at least two things. First of all, indeed, a massive recapitalization, and I think it should be north of 100 billion euro. Secondly, it should be also, I would say, for all the banks. The banks would be left no choice. They would be forced to recapitalize. And secondly, we also have to see, I would say, more measures with regards to Greece, the bailout, the haircut, and we also have to see, I would say, more news on how other peripheral countries will keep their access to the bond market at sustainable interest levels.
Well, you know, Patrick, I just want to move on now and take a look at your opinions on emerging markets, what we can expect in that part of the world. And you're saying, well, don't expect much relief when it comes to these regions. Your report points out that financial decoupling is essentially still a myth. A high correlation with developed markets means that they are still vulnerable to global risk aversion, if you like. You also say emerging equities are strongly linked to commodities. A prospect for low growth and high risk aversion is going to peg back commodities for a while. And actually, just looking at what's been happening with crude oil, that's been dropping. And then, of course, we're also seeing copper in London dropping for the first day in 5 on signs of slower demand coming out of China. Just tell me a little bit more about why commodities are going to have such a tough time.
Well, for two reasons. First of all, you have actual demand for commodities that, of course, is closely linked to global growth and especially to growth in emerging markets. But secondly, what we also see is financial demand for commodities, which on its turn it's hit by increasing risk aversion. So the combination of a somewhat lower real demand for commodities with high risk aversion could indeed bring commodities down quite a lot. And I'm thinking more specifically to the industrial metal sector, where if you compare current prices, current levels with, for example, last year levels, well, we're still above where we were 12 months ago. So we fear that there's quite a lot of downside from current levels with regards to commodities. On the other hand, we do not expect them to fall back to the levels we saw in 2008, 2009, simply because, well, we are only expecting a moderate slowdown, not a standstill like we saw in 2008.